Welcome back to the Deep Dive. Our mission here is, as always, to take a monumental stack of sources, articles, research papers, historical notes, and really just distill it all down into the essential knowledge you need to be truly well-informed.
And today, we are tackling the absolute foundation of modern commerce, of investment. We're talking about the stock.
Right. And for most investors, a stock is just a fluctuating price, maybe a line on a chart.
It is, but its power comes from the legal definition behind that line. We're not just looking at ticker symbols today.
No, we are unpacking the essence of corporate ownership itself. We're going to trace its surprising, and I mean really surprising, historical roots back 2 millennia.
We are. We're also dissecting the often conflicting classes of shares. And then this is the crucial part, delving deep into the philosophical and psychological theories that dictate its price. Every single second the market is open.
Absolutely. The concept seems so simple on the surface, fractional ownership. But the implications of that tiny fraction are they're vast. So let's start with the technical foundation. Stock, or I guess more formally, capital stock, is all the shares by which the legal ownership of a corporation is divided.
And that division is the core mechanism. A single share means you possess a fractional piece of that corporation.
Just a little slice.
Exactly, a little slice. But that ownership, it's not symbolic. It usually entitles the shareholder to a proportional fraction of some very tangible rights.
Like what, specifically?
Well, first, the company's earnings. Then, any proceeds left over during a liquidation, and we'll definitely stress later how far down the priority list you are in that scenario.
Right.
And critically, voting power. It's proportional to the number of, shares you hold.
And that distinction, like shares, that's where all the complexity comes in. As our sources emphasize, corporate structures are really dynamic. They allow for shares with all sorts of varied or restricted rights.
It's never a simple one-size-fits-all product. And that differentiation, that's what we have to master today. It's what explains why some people have all the control and others are simply along for the ride, just hoping the value goes up.
Okay, let's unpack this. We're going to start with the granular mechanics of those shares, clarifying the language and even the ancient documents that define this whole relationship. To begin, we really need to be precise about the terms themselves. We often use stock and shares interchangeably, but what's the strict technical difference in the world of finance?
It's a great question because people do mix them up. The distinction is really one of unit versus the aggregate.
Yeah.
The shares are the fundamental units of ownership, a single share. Then the collected units, all of them together, form the stock or the capital stock of the company.
So when a business incorporates, it says, we authorize 1 million shares. That's the total pool.
That's the total potential ownership pool.
Right.
Even if not all those shares are initially issued or sold, that authorized number defines the whole pie.
That brings up a topic that sounds incredibly technical, but historically it was paramount, and that's par value.
Oh, yes.
You see it on old documents or even modern balance sheets, and it's often this ridiculously low number, like 1/10 of a cent. Why does it even exist? And why is it so sort of meaningless today?
It's basically an accounting artifact now, but it didn't start that way. Historically, back in the 19th and early 20th centuries, par value was genuinely significant. It was intended to represent the minimum legal price for a share.
The floor price.
The absolute floor price. The idea was simple. If a stock had a $10 par value, the company had to sell it for at least $10. And that $10 was supposed to serve as this permanent cushion of capital for the company.
So it was originally a safeguard for creditors, to make sure there was some money in the company.
Precisely. It was meant to protect people who lent the company money, the creditors, by ensuring the corporation retained a minimum level of stated capital.
It was supposed to prevent the company from, issuing shares for a penny, paying that out to the owners, and then just collapsing.
That's exactly the kind of scenario it was designed to prevent, leaving nothing for the banks or suppliers.
But that mechanism failed, didn't it?
It failed spectacularly, largely because corporations are, clever. They quickly realized they could just set the par value arbitrarily low, 1 cent, or even have no par value shares in some jurisdictions. They completely circumvented the restriction.
So today, when you see a par value of $0.0001, it's just a bookkeeping placeholder.
It is. It's used on the balance sheet to differentiate legal capital from what's called paid-in capital surplus. That's all the extra money they got above the par value. But its abandonment is what's really significant. It shows the shift in regulatory focus away from these old minimum capital rules and toward modern ideas of solvency and financial transparency.
Speaking of artifacts, let's talk about the stock certificate. We live in a purely electronic world now, but that physical piece of paper, it once held immense legal weight.
Oh, absolutely. It was the formal physical proof of your ownership. The stock certificate was the legal document. It specified the exact number of shares, the par value if there was one, and most importantly, the class of shares you owned.
So before computers, you had to physically hand over that certificate to sell your shares.
You did. You had to hand it over and endorse it, just like a check. Even today, for private companies or certain restricted securities, the legal rights are still conceptually linked to that original documentation, even if the trading is all dematerialized now. It's a fascinating example of how legal tradition adapts to technological speed.
Okay, now we get into the main split in corporate structure, and this determines everything. Control, risk, potential reward for the shareholder. I'm talking about common versus preferred stock.
Right, and common stock is the foundation. If you go online and buy Apple or Tesla, you are buying common stock.
And its defining characteristic is?
The voting right. Common shareholders elect the board of directors. They vote on critical corporate matters. In theory, they control the destiny of the company.
In theory, we'll get to that. But what's the inherent trade-off when you compare that to preferred stock?
The trade-off is control versus certainty. Preferred stockholders, they typically surrender their voting rights, or at least they have greatly diminished rights.
And in exchange for giving up that control?
They receive a critical legal preference in two major areas. First, income. Preferred stock dividends have to be paid out before any dividends can be paid to common shareholders.
They get paid first.
Always. Second, liquidation. If the company goes bankrupt, preferred holders get whatever's left from selling the assets before the common stockholders do.
So if the company thrives, the common shareholder gets unlimited upside potential, the stock price can go to the moon, and they get to steer the ship with their votes.
Right.
The preferred shareholder trades some of that wild upside for a more predictable dividend income stream and a safer spot in line if things go wrong.
Exactly. Our sources actually define it as a type of hybrid security.
Yeah.
It has the fixed payout structure that you usually see with bonds, but the permanence of capital that you see with equity. It's a mix.
I've also heard of cumulative preferred stock. What does that add?
That adds another layer of protection. If the company is struggling and decides to skip a dividend payment, which they can do since dividends are discretionary with cumulative preferred stock, they have to pay all those missed dividends to the preferred holders before the common shareholders can ever receive a single penny in the future.
Wow. That's a powerful preference.
It's a very powerful preference.
And to add one more layer of complexity, let's discuss convertible preferred stock. This sounds like the ultimate hedge.
It offers a ton of flexibility. Convertible preferred gives the holder the option to convert their preferred shares into a fixed number of common shares, usually after a set date.
So why would you do that?
Well, imagine the company just hits a home run. The common stock price explodes. The preferred shareholder can then convert their shares and participate in that massive growth, shedding that fixed dividend for the unlimited upside of common equity. It's a way to get downside protection while keeping your upside potential.
And finally, let's talk class differentiation. This is so important for understanding modern corporate control, especially in tech or founder-led companies. Why do companies create different classes, like Class A, Class B, and so on?
They create different classes primarily to entrench control or to raise capital without diluting the voting power of the founders.
Give me an example of how that works.
A common structure is for Class A stock to have, say, 10 votes per share. That's reserved for the founders. Then they sell Class B stock to the public, which only gets 1 vote per share.
Ah, so the founders can own maybe 10% of the economic value, but still have 51% of voting control.
Precisely. It lets them raise billions from the public market without ever risking losing control of their company.
The famous example is Berkshire Hathaway. They have BRKA and BRKB shares. What's the functional difference there?
It's a great example. Historically, the A shares were incredibly expensive, carrying massive economic and voting power. The B shares, which people sometimes call the baby Berkshire shares, were created to be affordable for smaller retail investors.
So it's about accessibility.
It's about accessibility and proportion. A BRKB share has a significantly smaller claim on the company's economic value and dramatically reduced voting rights compared to a BRKA share. But they allow smaller investors to buy into the company. These letter designations, they're essentially legal footnotes telling you that the rights are different. You always have to read the prospectus to know exactly what rights that specific class gives you.
Okay, so we understand the unit of ownership. Now, what does it really mean to be a shareholder? A shareholder is the legal owner of that fractional share. When you buy that stock, what are the 4 fundamental privileges you immediately gain? And why is one of them so often overshadowed by a devastating caveat?
The privileges are foundational to corporate law. First, and we've touched on this, is the right to vote. Often it's 1 share, 1 vote, and it's primarily for electing the directors.
Okay, that's number 1.
Second is the right to share in income distributions, which we call dividends, if and when the board actually decides to declare them. Third is what's called the preemptive right to purchase new shares the company issues.
Why is that one so important?
It's a vital protection against dilution. It lets you maintain your proportional slice of the pie. If you own 1% of the company, you get the right to buy 1% of any new shares they issue.
Got it. And the 4th right is the ability to claim a share of the company's assets during liquidation. This is where we need to introduce that critical caveat, the one that every single investor must internalize before putting a single dollar into equity.
This is maybe the most important lesson of all. The shareholder's claim on company assets is strictly, absolutely subordinate to the company's creditors.
What does subordinate mean in this context?
It means last in line. We call it the liquidation waterfall. The first people to get paid are the secured creditors, the banks that hold mortgages on the company's buildings and equipment.
Okay.
Then come the unsecured creditors, the bondholders, the suppliers who are owed money. Then, if there's anything left, the preferred shareholders get their share.
And only then.
Only then, after all of those senior claims are 100% satisfied, do the common shareholders, the owners, receive anything.
So in a catastrophic bankruptcy, like a major airline or a retail chain, the assets are rarely enough to cover even the top of that waterfall, which means the common shareholder.
The common shareholder who owned the company often gets 0, wiped out.
And that's the definition of equity risk.
It's the very definition. You're at the absolute bottom of the risk priority structure. Unlike a bondholder who is promised a fixed return and their principal back, shareholders only own the residual value. If that residual value is negative, their investment is worthless. It's why common stock offers the highest potential reward, but it also carries the highest inherent risk.
And the reason this whole structure exists is tied to this really interesting concept of the corporation as a legal person. This is a cornerstone of modern capitalism.
It's a complex legal fiction, but it's essential. The corporation is treated as an entity that is completely separate from its owners.
And that's the only way a massive enterprise can function.
It is. I mean, if you own 40% of the stock in a company, you don't own 40% of the building or 40% of the inventory. The company owns those assets. You just own a fraction of the legal entity that owns the assets. It limits your direct control, but it also provides a crucial reciprocal protection.
And that reciprocal protection is the principle of limited liability. This is often cited as the legal mechanism that truly fueled the Industrial Revolution and modern global trade.
It is the ultimate barrier. Limited liability ensures that if the corporation incurs debts it cannot pay, or if it gets sued into oblivion, the shareholders are not personally liable for those obligations.
So the most you can lose is what you paid for the stock.
That's it. The maximum financial loss a shareholder can ever incur is the amount they initially invested. Your personal estate, your house, your savings, they're all protected. Without limited liability, we simply wouldn't have the scale of corporate organization we see today. Nobody would take the risk.
Let's transition to how the company uses this structure for financial leverage. When a company needs a big cash infusion, they essentially have a choice between 2 paths that fundamentally alter their relationship with their owners.
Right. The choice is between equity financing and debt financing.
Let's start with equity financing.
Equity financing means selling stock. The most famous example is the IPO, the initial public offering, where a private company sells shares to the public for the first time to raise capital.
So they get a big pile of cash.
They do. But it necessarily dilutes the ownership percentage of all the existing shareholders, and it grants those new shareholders proportional voting rights.
Debt financing, on the other hand, avoids that dilution entirely.
Correct. Issuing bonds or taking out bank loans, that's debt financing. It raises capital without adding new owners or diluting control.
But always a but.
There is. It creates fixed obligations. You have scheduled interest payments you have to make, and you have to eventually repay the principal. This increases the company's financial risk profile because if you miss those payments, it can lead directly to bankruptcy. It's a constant balancing act between control and solvency.
Our sources also added a crucial, less glamorous point about the financial reality of most corporations. We focus on the big IPOs and bond issues, but daily business runs on something far simpler.
Yes, and that's trade financing. It's the engine room of commerce. It provides the major part of a company's working capital.
What is it exactly?
Trade financing essentially means using credit from your suppliers. Instead of paying cash up front for inventory or raw materials, a company agrees to pay in 30, 60, or 90 days.
So it's like a short-term interest-free loan from your partners.
In a way, yes. This delayed payment mechanism frees up the company's own cash, its working capital, for daily operations, for payroll, for unexpected expenses. It's the invisible, high-volume, short-term cash management that keeps the lights on. It far exceeds the initial capital you get from a typical IPO.
Now, regardless of the financing method, once you have shareholders, the owners, and you have management, the operators, you introduce this structural tension.
Yeah.
It's known as the principal-agent problem.
This is one of the most studied conflicts in all of finance and organizational behavior. It's fascinating. The stockholders are the principals. They are the ultimate owners who want maximized returns.
Okay.
Management, the CEOs, the CFOs, the executives, they are the agents hired to execute the principal's will. The core problem here is what we call information asymmetry and a divergence of incentives.
Management is legally bound by fiduciary duties to act in the shareholders' best interest. But if we connect this to the bigger picture, why is it that in practice, this fiduciary duty so often seems secondary to management's own self-interest?
Because management is human. They control the flow of information, they often set their own compensation structure, and they prioritize job security or what we call entrenchment.
What does that look like in the real world?
Our sources suggest that management often prioritizes empire building. Excessive ego-driven mergers and acquisitions that actually destroy shareholder value but increase the manager's personal status. Or they push for excessively generous compensation packages that reward just average performance. This creates an inevitable and pervasive conflict of interest that costs shareholders billions every year.
The theoretical solution is clear, right? The principals, the shareholders, use their voting rights to elect a new board of directors, which is the ultimate control mechanism.
That's the theory.
But in reality, contested board elections are the exception, not the rule.
In practice, the outside passive minority investor, the average person who owns a few shares, is largely powerless. Board candidates are almost always nominated by the existing board, which creates this self-perpetuating system.
And the insiders have all the power.
They do. Insiders, founders, large institutional investors. They often hold a significant block of shares that all but guarantees voting control. So even in a huge public company with millions of shares, the insiders can often retain enough effective voting control to perpetuate the status quo and keep management entrenched. It makes shareholder resolutions difficult to pass and activist campaigns incredibly expensive. It's just a constant struggle to align the interests of the operators with the interests of the owners.
So we've established the modern mechanics, the risks, and the conflicts. Now let's travel back in time, because the idea of fractional ownership and speculative trading, it is far from a modern invention.
And here's where it gets really interesting. When we trace the origin of stock markets, most people's minds jump to, the 17th century, the Dutch East India Company.
Right.
But the concept of tradable fractional ownership that carries specific legal rights, it goes all the way back to the Roman Republic.
Let's discuss these Roman roots. The Roman state, especially during the Republic, was massive. It required all these services: tax collection, military provisioning, building public works. But instead of doing it all themselves, they contracted these functions out to private companies.
Private companies called the publicani. These publicani, or societas publicanorum, were structured very much like early joint stock companies.
How so?
Well, to finance these huge, often very high-risk government contracts, they needed vast amounts of capital, far more than a few rich individuals could provide. So they raised it by issuing shares. These shares were known as partes.
And the sources mention an even smaller, more liquid unit of ownership, something that functioned almost exactly like a modern over-the-counter trade.
Those were the particulae. If the parts were the primary shares, the particulae were smaller fractions of them, easily bought and sold among Roman citizens in the forum. The orator Polybius actually confirms that almost every citizen was involved in these government leases. It suggests a massive, widespread participation in this early public market.
And we have hard evidence that this was a speculative market, prone to the same psychological forces we see today. The famous orator Cicero himself provided the key evidence of early price fluctuation.
He did. Cicero mentioned partes illa tempore carissime, which translates to shares that had a very high price at that time.
That's not just a record of ownership.
Not at all. It's confirmation of volatility, of speculation. Roman history is full of examples of these publicani firms collapsing after losing a government contract or engaging in corrupt tax farming practices, which caused the value of their parts to just plummet.
So the concepts of supply and demand, risk assessment, market bubbles, they aren't new. They were active forces in the Mediterranean 2,000 years ago.
Absolutely.
Okay, let's move forward a millennium to medieval Europe. The idea of fractional ownership reemerged. This time it was tied to more reliable, profitable infrastructure assets, not just risky government contracts.
And the prime example of this is the Bazical Milling Company in Toulouse, France, which was operating around the year 1250.
This wasn't some small local operation.
No, not at all. It was a complex of mills along the Garonne River. The company issued 100 shares, and the value of these shares was directly tied to the highly measurable, consistent profitability of the mills.
So there was this very transparent link between a share's value and the actual underlying asset performance. If the river flow was good and the harvests were large, the shares were worth more.
Exactly. It shows a really sophisticated understanding that a financial instrument's worth is derived from the cash flows of the assets it owns. You can contrast that with the Roman publicani, whose value was tied to these fickle, potentially corrupt state contracts. It makes the Bazical structure a much cleaner, more fundamentally sound model of early equity.
We also have an extraordinary example from Sweden, the Great Copper Mountain, or Stora Kopparberget. This is one of the earliest documented stock transfers we have on record.
The Follene mine, which was part of the Great Copper Mountain, was Europe's most important source of copper for centuries. In 1288, the Bishop of Västerås acquired a 12.5% interest in this highly profitable enterprise.
And the transaction was documented.
Meticulously. The fractional ownership was traded in exchange for a physical estate. This solidifies that by the late Middle Ages, the concept of a tradable, non-physical stake in a commercial enterprise was fully established in European law.
These ancient and medieval examples really paved the way for the birth of modern exchange trading. This required massive capital and the political will to manage risk on a global scale, which brings us to the age of exploration.
The immediate precursor to the modern corporation was the English East India Company, established in 1600. It was granted a royal charter by Queen Elizabeth I, which gave it a 15-year monopoly on all trade in the East Indies.
And that joint stock structure was revolutionary.
It was. It allowed for the accumulation of vast amounts of capital from numerous small investors. This spread the enormous risks of long-distance sea travel and trade among hundreds of people, rather than just a few wealthy patrons.
But while the English East India Company pioneered the joint stock structure, the crucial step toward creating a truly liquid modern market that belongs to their rivals.
That credit goes entirely to the Dutch East India Company, the VOC, or Verenigde Oostindische Company, which was established in 1602.
What did the Dutch do differently?
What set the VOC apart was the decision to issue shares that were explicitly made tradable on the Amsterdam Stock Exchange. The English company, at first, required investors to hold their shares until the entire voyage was complete.
So you were locked in for years.
You were locked in. The Dutch, however, offered investors an immediate exit strategy. They created a liquid secondary market where you could sell your share to someone else at any time.
And that distinction, liquidity, is everything, isn't it? It allows capital to constantly flow in and out of the company. It reduces the commitment risk for the individual investor.
It fundamentally changed the entire calculus of investment. It meant you didn't have to wait 5 years for a ship to maybe return from Asia to realize your profit or loss. You could buy today and sell tomorrow. This liquidity is what truly differentiated the modern stock market from its ancient predecessors. And it's what allowed the VOC to dominate global trade for 2 centuries, moving 2.5 million tons of cargo and cementing Amsterdam as the world's first true financial capital.
So the core stock provides ownership, but the financial world, it rarely stops there.
Yeah.
To manage the immense risks created by these massive enterprises, the market invented stock derivatives. These are complex instruments built on top of the underlying equity.
A derivative, just as the name implies, is a financial instrument whose value is derived from the price of an underlying asset.
So they aren't ownership.
They're not ownership at all. They are contracts, and they serve a dual purpose. They allow people who want to avoid risk, we call them hedgers, to transfer that risk, and they allow speculators to amplify their potential returns.
And the underlying asset here is either a single stock or a major stock index, like the S&P 500.
Correct.
Let's clarify the two main flavors because they're very different: futures and options. Starting with stock futures, what is the fundamental commitment involved there?
Stock futures represent an absolute commitment. They are standardized contracts where the buyer takes on the obligation to buy and the seller takes on the obligation to sell the underlying asset at a predetermined price on a specified future date.
And that commitment is legally binding.
It is. It's legally binding regardless of what the market price does on that date. If the underlying asset is a stock index, the settlement is typically in cash, which just means no physical shares change hands. Only the difference in value between the contract price and the market price is exchanged.
Now, stock options are much more flexible because they grant a right, not an obligation. And this is a critical distinction in understanding leverage and risk.
Absolutely essential. An option gives the holder a choice. There are two primary types.
Yeah.
A call option grants the holder the right to buy the stock at a fixed price, the strike price, before a certain date. You buy a call if you are bullish, if you think the stock is going up.
And the opposite.
A put option grants the holder the right to sell the stock at a fixed price before a certain date. You buy a put if you believe the stock price is going to fall.
The beauty of options is the embedded leverage. You can control a large block of stock for a small fraction of the cost.
Right, but if the price moves against you, you only lose the premium you paid for the option. That's your maximum potential loss.
And valuing that potential loss, calculating the fair price of that right itself, that's where some very sophisticated mathematics enters the picture. Our sources highlight the Black-Scholes model as the most popular and historically crucial method for valuing these instruments.
It truly revolutionized how options were priced back in the 1970s.
What are the key inputs that the model uses to determine the theoretical fair price of an option?
It assesses 5 key variables. First, the current price of the underlying stock. Second, the option's strike price. Third, the time remaining until it expires. Fourth, the risk-free interest rate. And, most critically, the expected volatility of the underlying stock.
So it tries to price in how much the stock is expected to bounce around.
Exactly. By calculating these inputs, it produces a theoretical premium, a fair price. This standardization is what allowed options markets to explode in size and liquidity. It moved risk management out of the hands of a few specialized traders and into the mainstream.
Options are also a critical tool for employee compensation, especially in high-growth tech companies. It's a mechanism that's intended to align the interests of the employee with the shareholders, but a lot of employees mistake the option for current ownership.
That is a very common misconception. Employee stock options are not ownership. They are the right to buy ownership at a future date at a preset price, which is called the grant price.
So they don't have any value at first.
Not until the market price of the stock goes above that grant price. At that point, the option is in the money. If the employee then exercises the option and immediately sells the stock they just bought, they get a windfall equal to the difference between their low grant price and the high market price, minus taxes. It's a reward structure based purely on future market performance.
Okay, moving from instruments to regulation, we enter the world of securities law with restricted and controlled securities. This is commonly known in the U.S. as Rule 144 stock. This sounds like a massive compliance hurdle for founders, early investors, and employees.
It is. Rule 144, which is mandated by the SEC, deals with shares that were acquired in an unregistered form.
Why would they be unregistered?
Because they were acquired privately. For instance, through a seed money round, in a merger, or through an employee stock ownership plan, an ESOP. These shares were never sold through a public exchange offering.
So, if they were acquired privately, why does the SEC care about how they are eventually sold publicly?
The SEC wants to prevent the sudden, opaque dumping of massive amounts of stock that could unfairly manipulate the market or harm uninformed public investors.
So it's about market stability.
It is. And therefore, investors who want to sell these restricted and controlled securities must adhere to a very strict set of conditions before they can be publicly resold. And this is where we get into the specifics of Rule 144.
What are those specific technical requirements for these investors?
There are 3 main conditions. First is the holding period. For non-affiliates, though, investors who are not directors, officers, or controlling shareholders, the securities typically have to be held for at least 6 months if the company is already public, or 1 year if it's not a reporting company. Affiliates, however, face continuous restrictions.
And what are the other 2 conditions?
Second, volume limitations. Affiliates selling within any 3-month period are usually limited to selling the greater of either 1% of the company's outstanding shares or the average weekly trading volume during the preceding 4 calendar weeks.
That's specifically designed to prevent a single large seller from just flooding the market and crashing the price.
Precisely. And third, there has to be adequate public information available about the company. The company must be current in filing its annual and quarterly reports with the SEC. These conditions together ensure that those private sales don't just circumvent the transparent regulatory structure of the public market.
Okay, so once a stock is registered and authorized, it needs a venue. We need to look at the trading mechanisms themselves. Where can you actually buy or sell a stock today?
There are really 2 fundamental venues. First, you have the established stock exchanges, the New York Stock Exchange, the NASDAQ, the London Stock Exchange. These are highly regulated and require companies to meet and maintain very stringent listing standards.
Standards on what?
On things like market capitalization, their total assets, and the number of shareholders they have.
And the other main venue is the over-the-counter, or OTC, markets. This is often where the public perceives a higher risk lurks.
That is a very fair assessment. OTC trading is an off-exchange mechanism where trades occur directly between parties, usually facilitated by dealers using electronic quotation systems.
And what kind of companies end up there?
Companies that are too small, too risky, or just can't meet the minimum requirements of the major exchanges. The main U.S. OTC venues, like the OTC Bulletin Board and the OTC Markets Group, frequently list what we call microcap companies, or even companies that have been delisted from a major exchange for failing to comply with rules, including companies in bankruptcy.
In either venue, the individual investor almost always needs a middleman, the broker. How have brokers evolved, and what are the main differences the listener needs to know when choosing one?
Well, brokers are the licensed firms that arrange the transfer of stock. And the primary evolution has been this massive shift from full service to discount.
Explain the difference.
Full service brokers provide comprehensive investment advice, personal portfolio management, and research, but they charge significantly higher commissions and fees. They really cater to clients who want and need that advisory component.
And the massive proliferation of online trading we see today is owed entirely to the rise of the discount broker.
Precisely. Discount brokers charge minimal fees, often zero commission now for trades, because they provide little to no personalized investment advice. They simply facilitate the transaction based on the client's explicit instructions. They appeal to the self-directed or the hyper-informed investor.
We should also note that there are some alternative ways to buy shares that bypass the brokerage system entirely, which shows that companies still want a direct line to their owners.
Correct. After you own an initial share, many companies will let you purchase subsequent shares directly through their investor relations departments, often via what are called dividend reinvestment plans, or DRPs.
And even more direct.
Even more direct are direct public offerings, DPOs, where a company skips the underwriter and the brokerage entirely and sells shares straight to the public, though these are typically much smaller offerings.
Now let's move into the truly aggressive instruments, starting with the ability to leverage your portfolio. Margin buying. Explain this practice and why it introduces systemic risk for the investor.
Buying on margin means you are borrowing money from your broker to purchase stock. You use the stocks you already hold in your account as collateral.
So if I have $10,000 in my account,
the broker might lend you another $10,000, allowing you to control $20,000 worth of stock. This amplifies your potential returns, but the debt isn't free. Brokers charge competitive, but still high interest rates, typically in the 8 to 10% range.
And the systemic danger is the possibility of a margin call.
That is the nightmare scenario. If the stock price declines, the value of your collateral decreases. If that value drops below the broker's minimum maintenance requirement, often set at 50% of the account value, the broker issues a margin call.
What does that mean? They call you on the phone.
They demand that you immediately deposit more cash or sell stocks to restore the equity ratio. And here's the crucial part. If you fail to meet that call, the broker has the right, without even consulting you, to sell your collateral at the current market price to cover their loan and the interest. This forced selling can lock in catastrophic losses, and it's a process that accelerates market declines.
If margin buying carries substantial leveraged risk, then short selling carries the profile of unlimited existential risk. It changes the entire psychology of the trade.
It fundamentally reverses the investment equation. When you short sell a stock, you are betting on failure.
How does it work mechanically?
The investor borrows shares from a lender, usually a brokerage. They sell those borrowed shares immediately at the current price, and they hope the price drops. Later, they have to buy the shares back at the lower price, that's called covering, and then they return them to the lender. They profit from the difference.
Why is the risk profile theoretically unlimited, unlike a traditional long investment where you just buy a stock?
When you buy a stock long, the most you can possibly lose is 100% of your investment. It can only go to zero. When you short, your maximum loss is theoretically infinite.
Because the stock's price can rise forever.
Exactly. A stock's price can rise indefinitely. If you short a stock at $100 and it rises to $500, you are still obligated to buy it back at $500 to cover your loan. That's a $400 per share loss. The psychological pressure of this unlimited liability profile is extreme. It's why short selling is the domain of sophisticated investors or specific hedge funds.
This inherent volatility and risk brings us to the fundamental philosophical question. What determines the price? We know the mechanical answer, but what are the forces influencing that mechanism?
If we connect this to the bigger picture, in the nanosecond to nanosecond reality of the market, the price of an equity is strictly a result of the instantaneous balance between supply and demand.
Simple as that.
Supply is the float, the available shares for sale. Demand is the volume of buyers at that exact price point. The price is merely the point where the last buyer and the last seller agreed to make a trade.
So if there's a surge of buyers willing to pay slightly more than the last trade, the price just ticks up until equilibrium is restored and vice versa. But what drives the sentiment behind those buyers and sellers?
That's where fundamental factors, technical factors, and crucially, human factors all come in. Fundamental analysis looks at the company's intrinsic value, its profits, its long-term outlook. We see outside influences like major analysts' business forecasts and the outlook for the company's entire market segment.
And there are some surprising correlations.
There are. Our sources cite a long-running study showing a significant positive correlation between customer satisfaction, as measured by the American Customer Satisfaction Index, and the market value of a stock. Strong, sustained customer loyalty directly translates into stronger market demand for the equity.
We also have to acknowledge the dark side of influence. Manipulative schemes like pump and dump, where coordinated misinformation is used to artificially inflate demand before the perpetrators sell their holdings at the peak. This just reminds us that the price mechanism is constantly battling rational analysis against coordinated human intent.
And that battle leads directly to the core philosophical tension in modern finance. The efficient market hypothesis, EMH, versus behavioral finance.
The EMH is the rational bedrock of finance. It's very controversial, but its core premise is elegantly simple. The market is smart, and pricing is purely rational.
The EMH posits that, at any given moment, a stock's price is an efficient and unbiased reflection of all publicly known information, all past performance, and the consensus expectations of future cash flows. According to this theory, the price accurately represents the intrinsic value of the company, the present value of its discounted future earnings.
But if the EMH holds true, it suggests two major implications for the average investor.
It does. First, risk must be rewarded. Since equity carries more risk than, say, a government bond, rational pricing dictates that the returns on equity have to be slightly greater to compensate you for that risk.
Makes sense.
Second, EMH implies that stock prices should follow a random walk. Since the price already reflects all known information, the price should only move randomly and unpredictably when genuinely new information is introduced to the market. This suggests that beating the market consistently through active trading is almost impossible because there are no hidden gems left to find.
But the EMH doesn't seem to account for the spectacular volatility we frequently witness. I mean, markets crash too hard, they rally too fast, they seem to be driven by mass hysteria sometimes.
And this is where behavioral finance comes in, arguing that the market is inherently irrational.
Because people are irrational.
Exactly. Behavioral finance introduces the human element. It argues that individual investors and the market as a collective frequently make decisions based on cognitive biases, fears, and misperceptions. And this causes prices to diverge dramatically from rational, fundamental valuation.
What are some of the most prominent cognitive biases that behavioral finance identifies as driving all this volatility?
Two crucial ones are loss aversion and herding. Loss aversion is the psychological phenomenon where the pain of a loss is about twice as powerful as the pleasure of an equivalent gain.
So we hate losing more than we love winning.
Much more. And this bias often causes investors to hold on to losing stocks for far too long, just hoping they'll recover rather than realizing the loss. It prevents rational capital allocation.
And herding is the simplest explanation for market bubbles.
Herding is the tendency of investors to follow the perceived actions of a larger group, often due to a fear of missing out FOMO, or a belief that the crowd somehow possesses superior information. This collective action can inflate asset prices far beyond any fundamental valuation, creating the conditions for spectacular bubbles, like the dot-com era or even some of the recent frenzies in niche sectors that are driven purely by social momentum. It proves that human emotion often trumps the cold logic of the EMH.
The ultimate cynical expression of this crowd-driven speculation is something called the greater fool theory.
This theory is beautifully simple. An investor buys an asset they know is fundamentally overvalued, based solely on the belief that another, less informed investor, the greater fool, will be willing to pay an even higher price for it later.
So the value of the asset doesn't matter at all.
It's irrelevant. The focus is purely on trading momentum and predicting the crowd's next move, not on the underlying corporate worth. It's the driving force behind many catastrophic asset bubbles throughout history. It acknowledges that even rational actors might participate in irrational markets simply to front-run the next person.
Finally, we should briefly mention arbitrage trading as the market's attempt to enforce pure, cold rationality.
Arbitrage is the exploitation of minute temporary discrepancies in valuation. If a stock is cross-listed on both the London and New York exchanges, and for a split second, it sells for slightly different prices, an arbitrage trader simultaneously buys low on one exchange and sells high on the other, locking in a guaranteed risk-free profit.
But that doesn't really happen anymore, does it?
Due to modern high-speed electronic trading and immense price transparency, true risk-free arbitrage opportunities are virtually non-existent for the average investor. The algorithms equilibrate these prices in milliseconds. Hashtag tag tag outro.
We've journeyed from the ancient Roman particulae to the complex mathematics of the Black-Scholes model. We've defined stock not just as a financial asset, but as a critical piece of legal and psychological infrastructure.
The essential knowledge to take away, I think, is the constant tension in modern equity markets. On the one hand, a stock is defined by legal, concrete rights, the preference structures of preferred versus common stock, and the protection of limited liability.
Right.
Yet its daily price is this volatile cocktail of rational, long-term discounting of cash flows. That's the EMH argument, battling immediate, often irrational speculative momentum, which is the behavioral finance argument.
We've seen that the historical roots of stock demonstrate that humans have been speculating on fractional ownership for 2 millennia, from the profitable medieval mills all the way back to the high-risk government contracts of Rome.
And this raises an important question for you to consider. Given that historical examples like the Bezical Milling Company show us that stock prices have fluctuated based on underlying profitability for centuries, how often does the immediate fear-driven speculation, the leverage, and the short-term trading of the modern market truly overshadow that underlying long-term asset value? Is the greater fool always waiting, or will fundamental value eventually assert itself?
A vital question to keep in mind as you assess the structure and risk of any asset you choose to hold. That's all the time we have for this deep dive.